Institutional investors operate in complex financial environments where numerous risks can affect their ability to achieve investment objectives and meet future obligations. These institutions include pension funds, sovereign wealth funds, endowments, foundations, banks, and insurance companies. Because they manage large pools of capital and often have long-term liabilities, institutional investors must adopt comprehensive risk management frameworks. Financial risks arise from changes in market conditions, economic cycles, interest rates, credit quality, liquidity availability, and operational factors. The nature and magnitude of these risks vary according to the institution's mission, liabilities, governance structure, and investment strategy. Effective risk identification and management are therefore essential for preserving financial stability and supporting long-term organizational objectives. Market risk is one of the most significant financial risks faced by institutional investors. Market risk refers to the potential for losses resulting from changes in asset prices, interest rates, foreign exchange rates, commodity prices, or broader economic conditions. Equity market declines can reduce portfolio values, while changes in interest rates can significantly affect fixed income investments and liability valuations. Institutions with global portfolios are also exposed to currency fluctuations that may impact returns. Because market risk cannot be eliminated entirely, institutions focus on diversification, asset allocation, hedging strategies, and risk budgeting to manage exposure. Understanding the sources and interactions of market risk is fundamental to institutional portfolio management. Credit risk represents another important concern for institutional investors. Credit risk arises when borrowers, issuers, counterparties, or financial institutions fail to meet contractual obligations. Pension funds, insurers, and endowments often hold significant allocations to corporate bonds, private credit, structured securities, and alternative investments that expose them to credit deterioration or default. Counterparty risk is particularly relevant when institutions utilize derivatives, securities lending programs, or other contractual arrangements. Effective credit risk management involves thorough due diligence, diversification across issuers and sectors, ongoing monitoring of credit quality, and careful evaluation of expected returns relative to potential losses. Strong credit oversight supports portfolio resilience and long-term financial sustainability. Liquidity risk can pose serious challenges for institutional investors, particularly during periods of market stress. Liquidity risk occurs when assets cannot be sold quickly without significant price concessions or when institutions are unable to meet cash flow obligations. Endowments, pension plans, and sovereign wealth funds often invest in private equity, infrastructure, real estate, and other illiquid alternatives that may generate attractive long-term returns but limit immediate access to capital. Unexpected spending needs, capital calls, or adverse market conditions can increase liquidity pressures. Institutions therefore maintain liquidity management programs that include cash flow forecasting, stress testing, liquidity reserves, and contingency funding plans to ensure operational flexibility. Liability risk is especially important for institutions with future obligations such as pension funds, insurance companies, and certain sovereign wealth funds. Liability values may fluctuate because of changes in interest rates, inflation expectations, longevity assumptions, or demographic trends. If asset performance fails to keep pace with growing liabilities, funding deficits may emerge and threaten the institution's ability to meet obligations. Liability-driven investing and asset liability management techniques help address these challenges by aligning portfolio characteristics with liability profiles. Effective management of liability risk requires continuous monitoring of funding status, economic assumptions, and the relationship between assets and future commitments. Enterprise Risk Management, ERM, provides a comprehensive framework for identifying, assessing, monitoring, and managing risks across the entire organization. Rather than evaluating risks independently, ERM considers how different risks interact and affect overall institutional objectives. The ERM process typically involves establishing risk governance structures, defining risk appetite, identifying material risks, measuring exposures, implementing controls, and monitoring outcomes. By integrating risk management into strategic decision-making, institutions can improve resilience and enhance their ability to achieve long-term goals. ERM recognizes that risks are interconnected and that decisions affecting one area of the organization may influence risks elsewhere within the institution. A critical component of ERM is governance. Effective governance establishes accountability for risk oversight and ensures that risk management responsibilities are clearly defined. Boards of directors, investment committees, senior management, and risk officers each play important roles in developing and implementing risk policies. Institutions must define risk tolerance levels that align with organizational objectives, financial capacity, and stakeholder expectations. Regular reporting, independent oversight, and periodic reviews help ensure that risks remain within acceptable limits. Strong governance also promotes a risk-aware culture throughout the organization, encouraging informed decision-making and timely responses to emerging threats and opportunities. The integration of financial risk management and enterprise risk management enables institutional investors to address uncertainty in a systematic and strategic manner. Market, credit, liquidity, operational, and liability risks cannot be managed effectively in isolation because they often interact during periods of stress. ERM provides a holistic framework that supports better resource allocation, stronger governance, and improved organizational resilience. For CFA candidates, understanding financial risks and enterprise risk management is essential because institutional investment success depends not only on generating returns but also on preserving capital, meeting obligations, and maintaining long-term financial stability. These concepts form the foundation of prudent institutional portfolio management and effective organizational oversight.